It looks like we have a few more people trickling in, but let's go ahead and get started. I want to welcome you. I'm Krista Holub, Strategic Research Program Manager at Intuit. And welcome to this webinar on building a stronger foundation for American families, options for a child tax credit. Just one housekeeping item, please do note that there's a Q&A option on your screen. We look forward to an engaging conversation. So please go ahead and post your questions in the chat throughout the conversation, and we'll make sure we get to some of those later in the hour. So please go ahead and submit when you have them. So to get us started, just a little context setting. At Intuit, we have a mission to power prosperity for our customers around the world. And for over 30 years, our products have helped taxpayers file hundreds of millions of tax returns. We're proud to say that in just the last 10 years, we filed more than 124 million returns for free. At the same time, we've seen how the tax code has impeded families, small businesses, the self-employed, and especially low-income workers from maximizing their well-earned tax refund. Since TurboTax was invented in the 1980s, the length of the tax code has tripled in size. We don't write the tax code, Congress does, but we believe that everyone deserves a tax code that they can easily understand. That's why we've been calling on policymakers to make a tax code that's more transparent, simple, and fair. And I'm delighted to be part of this conversation today. We proudly support the work of Nish Cannon, the Nish Cannon Center, and other tax policy experts, including the Urban Brookings Tax Policy Center and the Bipartisan Policy Center. We first became acquainted with Josh's work at the Nish Cannon Center on the complexity of the earned income and child tax credits. And for years, we've raised awareness on these credits among tax filers, but at the same time, have also expressed concern about their complexity. All of the data tell that these credits are essential to lifting millions of working families out of poverty, and yet they're overly complex to access through current law. And as Josh and Leah point out in their research, the poverty trap of the 1990s has been replaced with a just above poverty trap. Nish Cannon's work demonstrates that tax simplification does not have to just be a slogan. Taxes can be simplified and made more equitable, especially for those most in need. This paper offers 3 very practical and workable tax reforms to achieve those ends. From Intuit's perspective, we are not in the business of prescribing specific tax policy changes, but I'll say this again, taxpayers deserve a tax code that they can understand. So I'm pleased to introduce these 3 experts to present and discuss options for the child tax credit. First, we have Josh McCabe, Director of Social Policy at the Nish Cannon Center and author of the paper, Building a Stronger Foundation for American Families, Options for a Child Tax Credit. Next, we have Margot Crandall-Hollick, Principal Research Associate at the Urban Brookings Tax Policy Center. And finally, Rachel Snyderman, Director of Economic Policy at the Bipartisan Policy Center. We'll get started with some remarks from Josh.
Great. Thank you, Krista, and thank you, Margot and Rachel and the audience for being here today. We wrote this paper in response to what we saw as different trends over time. So there's I think 2 streams of thought when it comes to expanding the child tax credit. The first one is focused more on rationalization, the second one on generosity. So we see this first one with the Tax Cuts and Jobs Act of 2017, which eliminated personal exemptions in favor of boosting a standard deduction and doubling the child tax credit. So this is a sort of pure good example of making the tax code simpler by consolidating various child-related benefits. And then we saw in 2021 with the American Rescue Plan, it increased the value of the child tax credit, eliminated its phase-in, what's colloquially called fully refundable. And this is a good example of making it a bit more generous and simpler for families at the lower end. So these often happen, as we can see, under different trifectas at different points of time. And we often treat them as different substitutes. Some folks focus on one, some folks focus on the other. But we think they're pretty complementary. So Lee and I wrote a paper to try to bring some of these ideas to the fore. But we're standing on the shoulders of giants. There's some examples in the last few decades, including Gene Sterling and the National Commission on Children, Senator Romney proposal, taxpayer advocate at the IRS has a proposal. So I think it's time to return to these sorts of reform ideas and no longer keep them separate. So what we did in this report was think about what are the child-related tax benefits. So we know a lot about the child tax credit. It's really well known from the last few years, but there's several other that are still out there. Aside from the child tax credit, there's the earned income tax credit. It's probably the most second well known. It's a refundable credit that phases in for low-income families before plateauing and phasing out again as their income rises. And there's a per-child component added at different points in history. So in 1990, 1993, and 2009. There's the Child and Dependent Care Tax Credit. It's a non-refundable credit for qualifying child care expenses for children under 2. And this one is capped at 2 children. And finally, there's the head of household filing status. This one's a bit more complicated, but it provides more generous standard deduction and wider tax brackets for single parents relative to single filers without children. And this is just whether or not you have a kid. So we see capped at CTC is uncapped, EITC is capped at 3, CDCTC is capped at 2, head of household is de facto capped at 1. So there's a lot of child benefits out there. One thing to think about is trying to make them simpler in the same way that we got rid of the dependent exemption and sort of plowed that money back into the child tax credit. We wanted to see what are some opportunities for doing something similar with these 3 other child-related tax benefits. But there's been lots of proposals, so we should probably start with the 4 principles that guided us as we thought about this. And the first principle is that we should support children in need. So all these credits somehow exclude the lowest income families. So they all have some sort of phase-in. In 2021, we saw we got rid of the CTC phase-in, made it fully refundable. And that's probably the most straightforward way to address this issue. Other credits also cap the number of eligible children I had mentioned. So we probably want to make sure that all children are eligible for something like this. So we really want to support children in need, especially the lowest income children. The second one is we want to support marriage. So children do pretty well in a married couple home, but our tax code has quite a few marriage penalties in it. Structure of the EITC has a marriage penalty. Head of household status creates marriage penalties. So we want to make sure that parents are never penalized for getting married. Third, we want to support parental choice. So we want to help families do what works best for them in terms of family arrangements. An example here is the CDCTC has a qualifying expense requirement that can privilege certain types of care arrangements over others, whether that's dual earners, non-relative care, and can add some administrative burdens when trying to claim that. So we want to look for ways that we could reduce those burdens and support different types of care choices. And lastly, we want to make sure that we support upward mobility. So something that previous tax credit proposals have focused on was making sure that people aren't penalized for increasing their earnings or going into work. And one of the things that's changed over time, and Krista alluded to this, is that we fixed some of those in the 90s, but we moved them up a bit. So now that we have several programs phasing out at the same time, including the earned income tax credit, state earned income tax credit, SNAP, and a few others, can create what we call high implicit marginal tax rates for many working class families. So we thought, how can we consolidate these different tax benefits in a way that can deal with some of these issues, reduce them, eliminate them, but also make sure that we're supporting families, that no one is going to be worse off with some of these proposals. So what we did was we took the 2021 expansion as our baseline. It's a good expansion. It meets that first principle of supporting families in need. But one of the potential drawbacks is it leaves some of those other issues left untouched in terms of phase outs, marriage penalties, issues with parental choice. So in turn, we took the ARPA style CTC and we said, how could we potentially eliminate the head of household in conjunction with this expansion, eliminate CDCTC in conjunction with this expansion, and reduce the size of the earned income tax credit and reform it to deal with some of those marriage penalties and work penalties in conjunction with an expansion of the child tax credit. So our main goal was to make sure folks weren't any worse off, at least if you're lower or working class, and try to see what would happen with some of these issues. So we use Policy Engine, which is an open source software platform that computes the impact of public policies to estimate the cost, distributional impact of our baseline proposal, and some of these additional reforms. So we can see in the paper that if you have the baseline 2021 style expansion, it's pretty expensive. We estimate it would be about $110 billion in 2024, 31% reduction in child poverty, and 44% of households would be better off. No one would be worse off. So then we took that and we said, what if we integrate some of these other proposals? And you can see in the paper that you end up saving a substantial amount of money. You still have a pretty big bang for your buck in terms of poverty reduction, and most lower and working and middle-class families are all better off. So if you expand the CTC while eliminating head of household, the cost drops from about 110 to 84 billion, and you still have a similar amount of poverty reduction. And I think high income families, there's some that are worse off, but most folks are on net better off. If you expand the CTC while eliminating the CDCTC, you have a slightly lower cost. You save about 5 billion a year. You get about the same amount of poverty reduction, and the net impact is pretty similar. If you expand the CTC while shrinking the earned income tax credit, that is the other big one where you save quite a bit. You save close to $25 billion, a bit less poverty reduction, but it's still 23% relative to 31%. And most folks are still better off. So we thought these were good options to consider as folks think about expanding it, that we should expand it, but we want to think, how can we also reduce some of those marriage penalties, those work penalties, and some of those constraints on parental choice. So as we look forward to future tax debates, this is something that we think folks should consider. So thank you for that broad overview. I hope you read the report, but I will turn it over to Rachel for some comments.
Great. Thanks, Josh, and thank you for the opportunity to join you today. I know that this group in particular has been one where we've engaged with a lot of thought leadership and back and forth over the years in our research. So appreciate the partnership and the opportunity to join Ms. Gannon today. I think I want to highlight kind of 5 broad points that I think you bring up in the paper that I think are worth diving a little bit deeper into. I think the first is just the pendulum, swinging pendulum of changing tax policy over the years has really resulted in so much confusion and complexity for taxpayers and American families. I think what your paper does so well is that it shows that we can take the best ideas from both parties and very different reforms and drive innovative solutions, right? You focus on the expansions to the child tax credit in the 2017 Tax Cuts and Jobs Act, the Trump tax cuts, if you will, that really focuses on simplifying the code. But then also looking at the 2021 temporary expansion of the CTC, which really, as focus on generosity and ensuring that the program can reach families who before weren't eligible to claim that credit. Now, a lot of times when we think about tax policy and tax policy design, generosity and simplification are typically at odds. But I think that you've demonstrated that both can't be done in tandem. And also too, that strengthening these programs, and particularly, the child tax credit as we're talking about it, but also the earned income tax credit and the child dependent care tax credit, is that, strengthening them is not always about just making them bigger and more expansive, but it's also about fixing kind of the underlying longstanding plumbing issues, if you will, the administration elements of these programs. It's so critical to ultimately their take up by taxpayers and their success in alleviating poverty. The second point I wanted to raise is I think the bringing this principles-based approach as policymakers grapple with reforms to tax supports for working families is critical. And I think that this is especially important as we've seen the child tax credit debate dominate the policy conversation truly since the height of the pandemic. And I think that it's only going to continue to through the next 18 months. We've seen it right now currently in Congress and negotiations over a bipartisan tax bill, but certainly in the lead up of a big tax debate that's going to happen in 2025. So I think, supporting children in need, supporting marriage and parental choice and upward mobility, these are design mechanisms that can both incentivize work and support work while ensuring that these programs are targeted to vulnerable populations and the families that need the most assistance. When I was reading the paper, some other principles that kind of came to my mind too, as we kind of think about the negotiations and the discussions from here. And you rightly point out, the cost savings of potential reforms. But I think that's certainly this issue of fiscal responsibility, of pay-fors and offsets and ways that we can, make these programs also just more fiscally sustainable is really important. And I think, kind of coupled with that too is, of course, an underlying administrative issue that has long plagued certainly the EITC, but also, the child tax credit and other supporting programs is the issue of improper payments. And so, those are some other kind of broader principles that, I certainly think about when I think about potential reforms to these programs. Kind of a third element I want to dive a little bit deeper into is really the importance of work incentives and marriage penalties. And, that's a focal point of the current debate that we see on Capitol Hill as to how to strengthen these programs. And I think that, the way that the paper does this in tandem by kind of narrowing in on ways to strengthen the EITC, couple it with the child tax credit, reducing those phase out thresholds in the earned income tax credit to ensure that there isn't like this marriage penalties and there's not a disincentive for marriage for those workers who are qualified for the earned income tax credit is critical. And I think that we've seen over the years so much certainly in policy circles this conversation about it's really time to rethink these credits and have a child credit and a worker credit. And I think that bifurcation and the way in which you kind of explain that to readers is really important, and I think it's incredibly timely as we see as we're kind of march into 2025. A fourth point I want to bring up is I think the focus on the childcare industry and weaving in the child independent care tax credit is crucial. Our nation is experiencing a childcare crisis. There are issues of supply that's rampant across the country. We've seen in some areas in the country that families are spending upwards of 20% of their median family income on childcare. And these are then associated with lower maternal employment rates. And so I think that it's really important that we look at the broad scope of all of the tax supports that are available to families and how they interact with others out there, as rightly, the child tax credit and the earned income tax credit. I think the CDCTC is so important because it's really focused on providing that assistance directly to childcare expenses, as opposed to, the child tax credit being available at tax time. Point that I want to raise on that, because I know that you and I have had several discussions about our work on state level programs, is that as we think about reforms to these programs, and particularly the CDCTC and the EITC, many states across the country have their own state level versions of these programs, and some of which are coupled with the federal version. So we always have to think about when we're reforming policy at the federal level, some of the consequences and the ripple effects of how that changes state tax policy, and kind of proactively find the unintended consequences that could result in a change at the federal level, and how that translates down to the state level. We certainly saw a lot of that happen when the EITC and the CTC were temporarily expanded in the height of the pandemic. States had to kind of overnight react and adjust, frankly, their state budgets to be able to provide those programs that were coupled with their federal counterparts. But I think, important just always to think about that linkage. And just the fifth point, before I toss it over to Margot, is, this paper is so timely because when we think about the political feasibility of the reforms that you lay out here and just the policy window of opportunity that's around the corner, it's tremendous. We've seen right now discussions of a potential potential reform to the child tax credit kind of stall right now in Congress, but we know that discussion is going to be on the negotiating table over the next 18 months, as we're staring down an expiration of its temporary expansion at the end of 2025. And so I think that this is really a time for policymakers, for frankly voters and the public to really understand all that's at stake next year. And when we're thinking about how the tax code and social policy in our country, frankly, is directed through the tax code to support working families, and really think about some of the ways in which we can strengthen the tax code and strengthen these programs to ensure that they are reaching the families who need the most assistance, but also that they are administratively strong, that they and have kind of that foundation, if you will, of bipartisan support. So I think those principles of fiscal responsibility that I noted are so crucial. But I think that the timing again of this paper cannot be more important because of the fact that especially these programs, and particularly the child tax credit, we're just going to have more and more conversations like this over the next year and a half.
Thank you, Rachel. Great recap. I would double down on. I agree. I appreciate that principles-based approach, and always good to add to that list of fiscal responsibility. So thank you for your remarks. Over to you, Margot.
Yeah, I'm going to build off of some of the things that Rachel said, because I think they laid a really great foundation for a discussion, not only of this paper, but about what we're going to do next year, right? I've already seen an article today calling next year the Super Bowl of tax. So we are all going to be very busy, and I'm sure have a lot of webinars with different proposals. But when we're thinking about those proposals, whether they're for families or for other purposes, right now we're going to focus on families. I think what Josh and Leah's paper does really well is it starts off with what your goals are. Because I think if we can agree on the goals of what we want tax-based cash assistance, then the discussion can be more organized around how to achieve them and how best to achieve them. I think we might have different ideas, but if we have the same goals broadly, it can mean that we're working towards the same types of policies. And so I think that Josh and Leah's paper lays out some different proposals than historically, or goals than we've historically seen for tax-based cash assistance. And Josh knows that I love writing a good legislative history and looking at the evolution of policies like he does. And so, to underline that you want the first goal to be supporting children in need is very different from the original purpose that children and the personal exemption, which is temporarily suspended, were put in the tax code, right? That was for people who owe taxes to adjust for an ability to pay. You have more kids at home, you need more money that's not subject to taxation to cover those expenses. Whereas 2021, more than any other change to the child credit, really put kids and them as an investment in the future as the prime goal. Even though the expanded child credit, building on the TCJA expansions, which build on permanent law, weren't directed at the lowest of low income, right? That bump up of additional benefit went to people making over $100,000. $112,500 if they're unmarried parents, and $150,000 if they're married parents. It was still a huge boost for people who have often been left out of tax-based assistance or tax-based income supports, which are those who have low, little to no earnings. And all the prior debates about the child credit, the last time we were in a recession, 2008, were about lowering, tweaking some of these levers, but they were always conditional on work. And that is something that I know Rachel and the Bipartisan Policy Center wrote a really great primer on the whole debate about that. I think it eternally comes up. We see that with HR 7024, right? There is still that phase in because I think the goal of that is not necessarily to support children in need, but to support children in need who are in families that work, right? It's a little bit of a different goal. So insofar as you've outlined that as a goal, I think it makes a lot of sense. You're bringing back the expanded credit. And I think that's where we're going to see with the child credit kind of a lot of the tension around that, about, well, are we focusing on kids, or are we focusing on the families that they live in? In terms of marriage penalties, I watched your previous kind of seminar on kind of marriage and the role of marriage. And one of the things that struck me, and I'd be interested in understanding if you guys were thinking about this, or how you view this as a marriage promotion policy, was expanding a credit that has nothing to do with children. It is the earned income tax credit for families with no custodial children. So it could be a parent, a dad or a mom who doesn't live with their child or has no children at all. That is a very, very small tax benefit. You know that it was designed to offset an excise tax in the 90s. It was not designed to like lift families above poverty if they didn't have children. And you see that credit has not increased for decades. And it increased for 1 year. And this is a population that includes people who are just starting out. They have to be 25 or older in order to get it. There is virtually no tax-based cash supports for individuals who do not work and do not have children. And this is kind of a prime example of maybe thinking about expanding that, which I don't think was expanded in your paper. You were focusing more on the child aspect, which I totally understand from the goals that you set out. But in terms of marriage promotion, like setting people up to be employed and to be investing in their own human capital and to have that connectedness to the workforce before they have children, is something I'm kind of interested myself in exploring as a way to encourage marriage. And I think in the last presentation you guys hosted about that, it was really, marriage has become something that for lower income folks is less and less common. And I'm curious as to what people on this panel kind of think about that as something to promote marriage, maybe not in a direct way, but in an indirect way. I want to build upon something Rachel said about, and Krista said about complexity and improper payments. I want to be very clear that improper payments in these programs are driven by the rules around who can claim a child. The dollar amounts are the most, the dollar amounts in terms of incorrectly claiming a child are highest for who can claim a child. People changing their self-employment income or misreporting their wage income are a very small share of the dollar amounts of improper payments, although they're very common. And so I think there's this real challenge, and I struggle with it, and it has not been solved, of who can claim a child and how can we define those rules in a way that is maybe consistent across these consolidated benefits that you propose, but B, just works for different family types, right? That's easy for different families to understand, whether those are multi-generational families where grandmothers and aunts live with the parent, or if they include, people in the family who might not be related. This is a real challenge, but it's one of the challenges, I think, it's the plumbing that Rachel focused on. Like, we need to make this work for people so that they feel like they understand why they got the benefit, as opposed to, you have some rules for the EITC, right? It goes up to children who are 23 years old. You have some rules for the child credit, which can be traded in divorce, but the EITC cannot. There's so much complexity over just who can claim a child for an individual benefit that consolidation solves parts of those problems, but it doesn't solve all of them. And this is like a real, I think, challenge for all of us when we're thinking about, the bifurcation that we've talked about, putting, and you kind of go one step, maybe not the whole way, because there's still children who qualify you for larger EITCs in your proposal. But regardless of what you do, we have to kind of start thinking and wrestling with, how do we redefine those rules so that they work for families? And so honestly, they also work for the IRS and that they can enforce them. Because when you can't enforce a rule, I think it's one of the big drivers towards improper payments, right? When you can't, there are very little improper payments related to SSNs or W-2s because there's really good third-party data on that. We do not have a database of where kids live at night, and kids have to spend 6 months or more with a taxpayer generally to be claimed by them. we don't have a database, nor do I think we want a database of that, like the government knowing where kids are at night. And so I think we have to kind of rethink some of those rules. And I think the final one is on the CDCTC, that little credit that's like really small budgetarily in terms of number of claimants. It's got its own set of rules around children. I would say that one of the interesting things I find about that credit is that it is so that the individuals can work, right? It's not about high quality childcare for, let's say, enrichment of your child or investing in your child's well-being. It's about parking your kids so that you can work. It was also created in the 1970s, around the time the EITC was created, right? And so it's also tied to work. And I think one of the things your report kind of underlines is there are lots of ways that we provide really good care that aren't necessarily going to fit into the mold of that credit, but there are also like people are going back to school. You know, there are other reasons that people might need childcare, and we might need to be more flexible to support families that way.
Absolutely. Thank you, Margo. I just love that historical perspective on how we got here today, right? That's so helpful to understand. I do want to pick up on your fourth point around this complexity, right? And this point that it has to work for families to understand how they, why they're getting the benefit, and for the IRS, right? For our economy. Curious if you guys can expand a little bit more on that around why is it important to simplify this process? Are there other reasons than those that Margo laid out? And sort of forward thinking, what will the impact be if we are able to pull this off?
Well, I'm happy to share, Margo. I mean, just some, the statistics that we follow here at BPC, and I think, when we think about tax code complexity, I mean, for example, in 2022, Americans spent over 6 billion hours complying with tax laws. And that's just, gathering those receipts, statements, records, the general tax prep that we all do to get ready for, what is April 15th this year. There's a great study that's done by the National Taxpayers Union that really estimates that opportunity cost each year of the tax code complexity. And in 2022, they estimate that to be $260 billion. I think when I was scrolling through the Form 1060, the instructions for the Form 1060, which is the main individual income tax return, filed by most Americans, it's 114 pages long this year, just the instruction manual. That's down from 257 pages last year. So, I think a lot of folks blame the IRS for the complexity in the code, but and frankly, some, the broken processes and procedures that the agency, but really the tax code and the complexity ultimately lies at the feet of Congress. And so that's why, we've seen as we've discussed all of these credits, and they've been tinkered and expanded and changed over the course of the past decades. That's only added complexity to the code. And so, especially here at the Bipartisan Policy Center, we've been supportive of ensuring that the IRS is adequately funded to modernize its technology and especially its taxpayer services. We've of course now seen a lot of that be used as bargaining chips in discussions over the budget recently, but I do think that right now, as it stands, the agency's plans to modernize and really invest in that taxpayer outreach and communication and support is vital. But they're also ambitious goals, and they need funding to be able to adequately follow through on that. But I'll definitely turn it over to Josh and Margo for more thoughts on that.
Yeah, I think something I think a lot about in terms of complexity is allowing families to plan in the face of what can often be volatile swings in income, particularly for low-income families. So with all these programs, you've got phase-ins, you've got phase-outs, you've got plateaus. I think it's really hard for families to figure out what any change in worker earnings might do for their refund at the end of the year. So we have some evidence that families have a bit more trouble reacting to annual or lump sum payments and trying to figure out what they did during the year might impact them versus monthly payments. And I think that's especially the case for benefits that phase out versus ones that are just flat. So we know with SNAP, families typically know what some change in income will do because that'll change their benefits from month to month, and they react to that. Versus for, I think, the important thing for child tax credit is to have it as flat as possible. And if you do have some sort of phase out, do that 200, 400,000. So that way families can know from month to month, I'm going to have, at most or at least $600, right, for my 2 kids or what have you. And if I earn a little bit more, I still have that 600. If I earn a little bit less, I still have that 600. So I think this helps with families who are potentially cutting back hours, getting more hours, moving from welfare to work and back again. They don't have to be as concerned as they might be about losing some benefits. So I think the more that benefits come from a flat child tax credit and less from other programs, it just makes it a lot easier for families to plan their lives.
And to build on what Josh and Rachel said, a flat benefit, it was flat, as I said, over a really wide range of income. And that was one of the key factors that made it easier, and I mean easier both for the IRS, but also for families less likely to have to repay any amount because of income volatility, to get it as an advance, right? The tax system is a big system. It is an annual system. It looks back. When you're doing your taxes, we're always looking back at the prior year. We're looking at our household in the prior year. We're looking at our income in the prior year. To advance that credit, they used prior year income, right? My understanding from talking to my friends is they only want to interact with the tax system once a year. And so they were using prior year income. They weren't asking generally for new information, although they did have some update portals the IRS developed so people could update things if they needed to, certain elements. But that allowed advancing to occur. And there was a very generous safe harbor, or maybe I wouldn't say generous, but there was a safe harbor for if kids moved around and you got the wrong amount of the payment, there was an ability to opt out. If you thought like, hey, the child actually lives with the other parent this year, not me, I shouldn't be getting it. So design can really help with some of the administrative complexity and that flatness that Josh, the fact that it's not phasing in, the fact that income is taken out of it as a variable now, that might mean that your credit changes in value, can be really beneficial. I do think that one of the tricky things it highlighted was we still have about 4 or 5 definitions of qualifying children in the tax code, right? And so I think when we're thinking about that, it's less with the advent of software and paid preparers. Most people use paid preparers and or software or some combination of both. It's less about the computational complexity. I draw the graphs, we all draw the graphs, but like taxpayers don't draw those graphs. What's complex for taxpayers is the inputs, the questions that they're asked about, did the child live with you? Did you support the child? The questions used to be more confusing in 2004, before one of the Bush era tax laws passed and made some strides into simplicity, right? We used to ask people about, do you provide more than half of the support for the child? And so you had to kind of allocate your rent to the child and allocate your food budget to the child to figure it out. That was simplified, although I think we can argue with the rate of improper payments, probably not enough. But these are like the plumbing issues, the like not as exciting issues maybe, but the really important meat and potato issues. And I do think one of the things that we need to acknowledge is we might not have lived the experience of the taxpayers and the people that we're trying to serve. And so we need more input from the people who either do VITA preparation or serve those communities to understand the diversity of families out there that would benefit from this support, whether it's multi-generational families or, it's a mom living with a partner and they're unmarried, and things like that. We need to kind of understand that universe so that we can assess the rules against that and say, is this going to work for these populations or not? We can't just kind of apply it to our own experience, right? Which I think is sometimes we don't talk about that in Washington, but like if you look at those rules, they work really well if you're married and have 2 of biological children in your house or adopted children, and you stay the same from year to year. The rules are really simple. The rules are not simple for more complicated families, and we know that there are more complicated families among the lower income families. So we need to start kind of talking about that and trying to find a way to accommodate that.
Yeah, absolutely. And family dynamics are changing more than when the tax code was put into place. So we need to be reactive to that as well in order to help families navigate what I think Josh said in the paper was a maze of family tax benefits, which couldn't be a more accurate description. Um, I do want to remind everyone to please go ahead and put any questions that you have in the Q&A. We're going to turn some of those. But just, one more point on that, I think I'd love to hear this idea of the impact on simplification for families and for our government. And it's always occurred to me, like, if we're trying to incentivize certain behavior that we've outlined in the principles, if you can't understand it, it's not going to be incentive. So we need to keep that in mind as we work towards, making it more clear for taxpayers. So let's turn, we have an audience question. This is for Josh. Can you explain how your proposals improve work incentives?
Yeah, so I think that goes back to some of what Chris said at the beginning. In terms of if I had written this paper in 1990, it would look very different from writing it today. So I like to use Gene Sturley's famous paper that inspired the National Commission on Children, where he was looking at some of the implicit marginal tax rates on moving from welfare to work. And back then, you had a very big AFDC program, you had a dependent exemption, and a very small earned income tax credit, and a very small SNAP program. His idea was to take the dependent exemption, a chunk of AFDC, and just make a flat refundable child tax credit as sort of a floor for each child. And in doing that, he reduced implicit marginal tax rates. They were, for some families, I think 93%, and his proposal reduced them to something like 73% in different cases. Fast forward to today, AFDC turned into TANF. Most of those programs are reaching far fewer families. The benefits are a lot smaller. We have a much larger earned income tax credit and probably a more generous SNAP benefit. So all those things were really helpful in reducing some of those barriers for moving from welfare to work. But we kind of moved those implicit marginal tax rates up a little bit, right? So now you have federal earned income tax credit begins phasing out around $20,000. For some families, SNAP benefits are going to be phasing out. Their state earned income tax credit, childcare benefits, and a few others. So what we've done is we've solved it down here by moving it up, and I think that is where I tend to focus my energies in terms of reducing those work penalties for folks in that income range, because it's not something we typically see. And going back to what a family see versus what do we see, when I make my charts and I stack them all on top of each other, that's when I see families are losing their SNAP and all their tax credits in a very short range. So that's what I tend to focus on. I do, in this case, if you're getting rid of the phase-in, you're sort of reducing the negative implicit marginal tax rates that were there. But I still think they're negative for a lot of those families. Not a whole lot of them are getting TANF, some are getting SNAP. So there's changes you could make if that was a concern to follow what Canada did when they expanded their refundable child tax credit. They worked with the provinces there where they also control social assistance to shrink it down a bit. You could do something federally where you potentially shrink SNAP benefits for children and put that money into a child tax credit. It's not something I did here because it fell outside the tax system. But I think that's like worst case scenario if you're really concerned that those families are going to reduce their labor and reaction. Those are things you could address that with. That said, I don't think there's a whole lot of families who are doing that sort of labor leisure trade-off and saying 3,000, 6,000, 10,000. If you've got kids, they're really expensive. And they require a whole lot, and getting in and out of the labor market is really tough. So I think most of those things that impact whether parents decide to marry are typically outside their control. It's tight labor markets or loose labor markets. It's how many hours does your boss have. It's what's your education level so you can get a job. So I think the supply issue on the lower end, I'm less concerned about, and that's why I end up focusing on that higher end.
Thank you. Very helpful. Want to turn to an issue that you raised specific to how these benefits work with other existing benefits that wouldn't be consolidated, such as employer provided FSAs or other benefits that we didn't discuss here in the paper. If you could expand on that, I know there's some interest in, did you look at the whole universe of how you could combine it into one? Or, I know that there was a lot of considerations you took into account, Josh, that what you could have included in the paper, but for purposes of simplicity, also it's helpful to have sort of 3 distinct proposals. So if you could maybe I'll talk a little bit more about where you see that overlap happening.
Yeah, so I'll start with the limitations. If you guys know Elaine Mag, she had a great paper where she laid out the 5 child-related benefits in 2013 when I was in grad school, and that was sort of my target list. Then 2017 happened, then there was 4. So I'm sort of knocking on those other doors to see how can we get that down to potentially 2 as the ideal, because most countries have an in-work credit just for workers and a child credit just for children. And ideally, those are the 2 you want to separate and have those 2 as the main credits. But I had mentioned you could also look at children's portion of SNAP. You could look at the employer tax benefits as well. I didn't, so I'd be curious to hear from other panelists their thoughts on some of those.
I mean, I think there are like a lot of things you could do if you're going to look at all programs, but I think one of the useful things about just focusing on tax, although it's not, a lot of low-income families get Medicaid, they get SNAP, and they get their credits, right? Those are for many people what they've got. There are other benefits out there, but they are received by so few people because they are not entitlements. They are either block grants or people there's only a fixed number of slots for subsidized childcare and things like that. So I sometimes think that discussion distracts us from the fact that there are just a handful of, big provisions that are really available to the widest group of low-income families with kids. But it's also like how laws are considered, right? Like you're writing a bill and it's going to Finance or Ways and Means if you're a tax, and you're not touching SNAP, which goes to a different committee. So realistically, I think this is a framework for people to look at, like, the tax rating committees or people who are on those committees to look at them, and kind of aligns with how policy, for good or ill, is made.
No, that's an excellent point that you bring up, Margot, because, I think thinking about the different jurisdictions and, that these programs sit in, across the tax and benefits space it's tremendous, and it's tremendously complex. And I think that this is where, in particular, the emphasis on outreach and education is so crucial. We spent a lot of time here at the Bipartisan Policy Center truly traveling the country, talking with local administrators, folks who are running VITA sites on the ground, directing their local health and human services departments. And they are the experts on the ground who are tasked with, helping identify folks in their communities who could be potentially eligible for, these benefits that are administered through the tax program. And also the need to be kind of well-versed enough that, like I said, earlier, that pendulum swing that we see in Washington, D.C. And so, I think that that's a part of the conversation that needs to, I think remain part of the conversation, is the fact that it's really about how we are also thinking about that linkage when it comes to the state and local outreach and education, because that's frankly how a lot of folks will hear about these programs and their changes and potential changes in eligibility from year to year.
Absolutely. I love that both you and Margot brought up this idea of really listening to the taxpayers in these situations and making sure that they're having a seat at the table in the policy conversations. There's only so much you can program without having that empathy for the people who are being affected by the programs. Specific to that as well, you know, you both talked about marriage penalties. We have a question here. How can we reduce marriage penalties without hurting single parents? Removing head of household, for instance, mainly harms single parents.
Yeah, that's a good question. I know previous proposals to eliminate head of household replaced it with, I think, nothing in some cases. So the important thing I think that we tried to do here was to make sure that lower income families would be better off in any of these proposals. For head of household, for example, low income families, you know, it's an upside down tax benefit. If you have low income, head of household does nothing for you. If you're middle income, median income for single parents, it does a little bit for you, but not much. If you're high income single parent, it's pretty valuable to you. So it's not a very good way to help single parents. So in this case, a refundable child tax credit, a more expansive one, is just a better way to do that. And I think in the paper we show low and median income single parents are better off under a proposal like that one. There would be some single parents that are worse off, and they tend to be making six figures, and there's very few of them. So that's something that should probably be part of the conversation. Where do we want to draw that line? Is it 100,000, 400,000 of making sure folks aren't worse off? But you know, we want to keep in mind, what is the existing distribution of any proposal look like? In head of household's case, it's just not a very good way to help single parents.
I would just say too, as kind of the tax policy debate, you know, continues over the coming year. I think when we're looking particularly at those phase out thresholds, you know, ensuring that for married couples, it's double what, you know, a single parent phase out threshold is. Like, that's critical, because if those are not equal, then you are creating implicitly in the code, you know, marriage penalties if it's less than double. Which could happen again with the child tax credit.
I noticed that, like, of all the proposals, the one that had the smallest, like, there were very few taxpayers that were worse off in any of your proposals. There was like a small share in the final proposal, which I was obviously very interested in, because you were shrinking the EITC and kind of hoping that most of the child benefit associated with that was like picked up by a fully refundable or non-phased in child credit. And I mean, that's always the struggle that we face when we want to do really big change, aside from the definitions, like just looking at the formulas and the ages of children. You know, it's really hard to do it without costing a lot of money and including everyone, because of, I think age is one of the biggest factors that drives, you know, which child makes you eligible for different benefits, although it's certainly not the only factor. But it's also something like I struggle with, like, how do you design that system? And you were obviously working very hard, because I was looking at the first and second deciles and looking and seeing like how many people do see a change that's more than 5% or less than 5%. And so I kind of wondered if, like, peeking about underneath the hood, like when you were iterating through the proposals you wanted, like what challenges you faced. Because I think for anyone who wants to make a worker benefit and a child benefit, we say it and it sounds so simple, and it's so hard to do without costing a lot of money. So I was curious, Josh, if you wanted to talk about that.
Yeah, I think with head of household and CDCTC, it was pretty seamless in terms of lower income families are going to be better off under any reform. With the EITC and the changes we've seen over the years, it got a bit more complicated. So you'll notice I don't totally eliminate the children's portion of the earned income tax credit, even though ideally I would like to do that, to have those separate benefits. But because I think we struggled to get a larger refundable child tax credit for so many years, the EITC was like the kludgy fallback of like, we'll just add another child component to the EITC. So I think that it's going to take a while to reverse that. I think it's worth reversing. So in this case, I shrunk it down, saw some families who were worse off, And then we sort of worked backwards to say, okay, what's the smallest we can get it to make sure everyone's better off, or at least held harmless in this case. So it took literally just tinkering with it for a few days to see what might pop up. But I think these are worthwhile things to get us started in the right direction. You can see there, I got it down to 2 kids. It's a smaller benefit because most of it went over to the child credit, but there's still going to be a bit more work done to make that happen. And it's still pretty expensive to do something like that. I think Senator Vance had a proposal to get rid of EITC marriage penalties last year, and it was super expensive. So when we do these things, I think it helps to do it in conjunction with other changes to do the things we want to do without, you know, having no money left in the bank at the end of the day.
Absolutely. And I appreciate that push to continue the conversation, because I do think that this is has some legs as we continue to debate this in Congress. And, you know, there's always options to look at other ways. I know there's been some question in the discussion about, have you considered X proposal or X way to do things? And there's definitely you know, lots of, like, as you said, ways we could tinker with it. But I think this is really helpful. I do want to ask one maybe provocative question, if you will. So to folks who would say, you know, these proposals are really looking at relaxing child and dependent care tax credit requirements in terms of reporting, and sort of that reducing the plumbing, et cetera. We've talked about erroneous or fraudulent payments. How do you see, or how would you ensure that these policies wouldn't necessarily increase erroneous claims and payments?
Yeah, I think Margot and Rachel covered it, but I think fewer definitions or streamlined definitions of qualifying child, I think we can do that tomorrow. But I think that would be really helpful for making sure folks know which kids they're claiming and which kids they're not claiming in different family situations. And for me, the other big one is just having that flatness. So not worrying about what your credit is going to be worth, depending on your income, which might fluctuate. Those are the top 2 for me. I'm sure Margot and Rachel might have others to add.
I mean, I would say focusing on improper payments, you know, when we look at what is driving those, again, it is who is claiming the child and the rules around them. And some of those rules are the really nitty gritty, like tiebreaker rules, which don't give families a lot of flexibility to choose amongst themselves of who's going to claim the child for a particular benefit. They can be pretty rigid. And so an aunt who claims it because they live with the child for 6 months of the year might not qualify under the tiebreak rules if the mother claims it. Like, these are kind of like really tricky situations, but I do want to stress that there's a lot of evidence to show that people who are improperly claiming these credits are not random people off the street who have never met these children. They're often people in complex family relationships who may indeed provide care and support to those children. So it's a really tricky topic. And I think it's one of those things that we need to like do more work on and think about, but it's not easy, right? Like, there are some things that are easy, but some of those family relationships and accommodating them without making it even more difficult for the IRS to enforce, I think can be kind of tricky.
Yeah, and I'll just end with, you know, we need to regulate unenrolled tax preparers. That's an issue. And when we see, you know, when we look at the data about especially EITC improper payments, you know, a large swath of those are from, you know, folks who are not qualified and frankly, you know, in some cases taking advantage of individuals that then lead to, you know, these improper payments and audits. And so there's bipartisan legislation that's been introduced. I know this was a proposal that was included in President Trump's previous budgets, President Biden as well, and Obama. But you know, that's an issue. Like, we need to, there are standards in place that are standards that we need to put in place, and the work is already done. It just needs to be passed.
Absolutely. Thank you. Thank you for those remarks. I'm going to wrap us up. Really want to thank the panel for such an informative discussion today. It's clear to me from your conversation that we actually have real viable options for reforming family tax benefits. and making them more equitable for working families, making sure that, as Josh pointed out, we give families the opportunity to plan based on these tax credits, and making the plumbing work well. So I want to thank our audience for joining the conversation, and we ask that you know, if you benefited from these ideas today, that you help us broaden the conversation to those who couldn't join us today, to keep this conversation going. So that concludes our program. Thank you all so much.
Yeah.
You.